times amount times yield. And what that equals is how people typically become millionaires, is that it's over time. And one of the great ideas in the stock market is this idea of time times amount times yield. And what that equals is how people typically become millionaires, is that it's over time. And I believe that most people have a misconception of what that means. What does time mean? What does amount mean? What does yield mean? And we're all allotted a certain amount of time in life. And what we do with that time, or how much time, whether it be actual time we devote or money or energy, is up to us. So you're given time. How much of it you want to allocate to an activity, a thought, a process, a system is up to you. The result of that is what we typically call yield. And this idea comes from like farming. If you plant 10,000 seeds, your yield will be higher than if you plant one seed. Well, as you understand how these three work together, it's going to help you to get to being a millionaire if that's your goal. Now, if that's not your goal, this same concept can be applied to other things in life. But for me, it was about financial freedom, right? Or you might call it financial independence, FI. You hear people refer sometimes to the concept of FIRE, this financial independence, retire early concept. I'm not really into that because I really don't have much interest in retiring, but I do love the idea of time times amount times yield. And I want to show you how that works when it comes to the stock market. Now, last night, I received a series of a couple dividend payments. And as you see here from BX, it was $184. In another account, it was $120. So for a combined total, basically $400 and some change. Yes, I have the stock broke up in two different accounts. One I could access, one behind a tax-sheltered wall. So what we got so far is a $220 payment plus a $180 payment. Basically comes to $400. Now, the way stocks work, if this pays quarterly, okay, so quarterly comes out to every 90 days. So every 90 days, I'm going to get this. Now, if you drip it, meaning take this $400 and buy $400 more in shares, when they pay this dividend the next go around, you're going to see this go up. It's probably going to be like, assuming they don't lower the dividend, it's going to be like $400 and maybe 3 or 4 cents. We'll have to go see. So if we come over here to stock charts and we put in BX, wrong one, BX Blackstone Group, and we pull it up, we can see the price today is $101. So we'll keep the math simple, and we're going to say that's going to add 4 shares to our share count. Well, here we're looking at the basics of the stock BX, and we see that it pays $1.27 per share. Notice the yield is $4.99, meaning if you buy this stock today and you paid $101 for one share, every 90 days, they will give you $1.27 per share. So if you had 100 shares, they'll give you $127. So if you see someone post what they received as a dividend, you can simply go find how much the dividend is, divide how much they got paid by this number, and you will know how many shares they have. You could then take that share price and figure out how much money they have invested in the stock. So in our situation here, I said 403. What we figure out is what it comes out to be is actually, we said $1, so it comes out to be $404 on the next payment 90 days later. Well, what is it going to be 90 days from that? Well, Same thing. We're going to add 4, but we're probably going to add just a couple more cents. And then it's going to go to 408 on the next payment. And then what? 412, except it's probably not going to be 412 due to compounding. And that math gets a little complicated trying to do it here in freestyle. But next one's going to be like 412. And then we're going to be like at probably 17 by the end of the year. And so you see this in a 12-month period, the dividend went from 404 to 407. And we can begin to project this out. And you could see, where would I be in 20 years, 30 years? You can actually compound that. The math gets a little complicated because it's compounding math and not static math. But I think you get the idea here. Now, here's something that's interesting. BX, you see, is my third largest holding here. Now, here's something interesting. When I run it all together and I lump, because I actually have this broke up in 2 different accounts, but you can put them all together here. BX becomes my largest holding, and it comes to 322 shares for a value of $32,000 for a total gain of 230%, or $22,736. A lot of people would like to harvest this and, I don't know, do something with it, or maybe put it into a different stock. I don't know what you might think you want to do with it, but that there, they'll get rid of that. The problem is that there is this here, which produces the yield. Now, here's my case for not selling this. I'm going to show you how my dividend yield is actually 16% a year. So imagine having a CD at the bank that paid you 16%. I mean, this is getting into real estate appreciation levels here. So you might be thinking, how can I say that I get a 16% return on a stock that only yields 4.9%? That's called time, my friend. Time. The element that people misunderstand and how powerful it is when you waste it. For most people, time is working against them. So when I bought this stock, I basically in the year 2016 devoted over that 1 year period. I mean, couldn't you come up with 10 grand in a year? So in a year, I put about $10,000 into this stock, and I'm going to show you that and show you the actual dates, transactions, and purchases. Since the year 2016, I really haven't done much. Now you might say, well, why didn't you keep doing it? Because I went on to buy 17 houses and about 77 other stocks, okay? So my goal is to do a deal. So for me, doing a deal back in the day, if I could put down 10, maybe as high as $15,000 on a house, then that house would go into this cycle of time times amount times yield, okay? And that's what BX did. And I can show you this in houses. I can show you this in a bunch of other stocks as it plays out. So I have $10,000 invested in the stock, and at the time it was yielding about 4%. Well, fast forward now in the stock, my value of the stock is about $32,000, so about 32K, for about 22K in appreciation. This was higher at one time. But my dividend yield, we said, is $1,600, right? Remember, $400 a quarter. But guess what? This is constantly going higher and higher and higher, remember? So, I mean, to the tune of $20 to $30 a year. But then that's compounding. Well, if you simply divide your dividend payment of $1,600 and you divide it by how much you have in the stock, it'll give you your actual yield. Over time, your yield in a stock will grow higher and higher and higher, because as they pay you money and your position grows larger and larger and larger in the stock, you still only have, I only have $10,000 in the stock. And I've only ever had $10,000 in the stock since the year 2016. Now the stock's gone up, gone down, and gone up, and gone down, and during the COVID crash, and back up, and back down. But my money was put in one time, meaning what is going on here? In the year 2016, I accumulated $10,000 in this stock. And at the time, it paid a 4% dividend yield. Okay, well, do the math today. I received $16,000. You divide that by 10,000, and that's going to come out to 0.16, or in other words, 16%. You can actually do it because it's even numbers there. But my return on the stock currently, based on its current dividend yield, is I'm receiving a yield of 16% on my $10,000 invested. This is the effect of time. So if I wanted to increase my yield, I just got to put in amount. And so the amount I put in, the time, we've got since the year 2016. So what is that? That's 6 years. So 6 years invested. I put $10,000 in 6 years ago, just 6 years ago. And what's the yield? So remember we said time times amount times yield. Well, we've decided the yield was 16, we did the math there, it was 16%. So now we have time times amount times yield. Now here's the thing, this continues to go higher and higher and higher. Could something go wrong? Yes. Could the stock cut its dividend? Yes. This is why we diversify ourselves. All right, so like I told you, I have this broke down in 2 accounts. The other account's very similar, and we'll see how it looks. In this account, my total balance right now in BX is $17,685. That's at today's price. Obviously, the stock's been a lot higher. Stock's been a lot lower. My average price paid is only $29 a share. Remember, 6 years ago. The even numbers you see is when I bought shares. So if you look, I bought 18 shares in the year 2016 in October. I bought 16 shares. So these are out of order, but it starts on 03. No, where does it start? It starts in 02, 03, something like that, of 2016, okay? So we've got 18 shares, 15 shares, 12 shares. This was actually a dividend payment. 11 shares, 10 shares, 10 shares, 10 shares. Those are the blocks that I purchased. So this is all my purchasing, 18 shares, 15 shares, 12 shares, 11 shares, 10 shares, 10 shares. And this is over the year 2016. And you're like, well, why didn't you keep going? Well, I bought other stocks because it stopped being as cheap. Look, it's in the 20s. It was cheap then. And look how much I'm up since I did that. I turned my attention to other things that I thought at the time had more upside. It's easy to look back in history and have with perfect vision, but you didn't know that at the time. So in the year 2016, I devoted $10,000. Took me about a year to get into this stock. And so I try to find, if you notice, I target 1 to 2 stocks a year. Right now I've been building Hasbro, I've been building Hanes brands. I might do a little drip ads here and there, but I'm focused on most money going into 1 stock a year. These start the dividend drips. So look at this. Got paid a dividend. That dividend is up $369 for 4. That means the dividend was $100 and something bucks, but it's now turned into $540 because it appreciated at 217%. And so it bought me 5 shares, 4 shares, 4 shares, 3, 3, 3, 2, 2, 2, 2, 2, 2, 1, 1, 1, 1, 1, 1. Why? Because as the price went higher, the dividend yield bought less shares because the price was now, higher and higher and higher. There's the price is $51. Oh, wait, it's back down to $29. Wait, no, it's $24. Oh, wait, no, there's the price. It's $113, right? So I don't sell. I just keep it. And as time goes on, these are dividend payments. I'm collecting dividend payments, 2016, 2017, 4 in 2018, you see what I'm saying? And so these become dividend payments. There's 2. Look, there's some in 2020. Here's one in 2022. It bought me 2 shares. So this last one in 2022 would have bought me 4 shares. So we could go find it. There we go. Look, what is that? 08/08/22. And that comes out to 2 shares. But remember my other account. I have about the same number. Now, here we go in my other account. I started buying some, and then I bought 84 shares. Remember, it was at $22. So at the time, that was about $1,800 investment. And then here I bought 13 in 2018, and then I bought 9 in 2016 again. And that's about all the buying there is. And then it's just dividend. There's 4 dividend payments a year. We go forward 6 years, that's 20-something payments. And that's what you see happening here. As the stock price gets higher, obviously I'm buying less shares. But as we keep ticking and we tick on and we tick on, you can see the return on that, right? So what's happening is, as you saw, there was I bought 15 shares, and at the time that was it was 20-something dollars a share. So we're talking about, I put $300 in the stock, and then a month later, I bought 15 shares. That was another $300. Then you see me buying 14 shares. Then you see me buying 10, and then 5, and then 5. And in my other account, I did a one-time purchase of 84 shares, and then you see 15, and then 5. But all of this is happening in the year 2016. Because I committed, after researching, liking the stock, that I wanted to get $10,000. Well, guess what, guys? I don't have unlimited money. I wasn't balling out then. That took me 1 year, took the entire year of 2016 to accumulate $10,000 in that stock. Fast forward 6 years, we have time times amount times yield, right? Times yield. And what that equaled is turning my $10,000, right, into $32,000. Now, some people say, oh, man, I should go spend that and buy it. I know, because you don't understand the power, or those people, I know you understand it, of 16% returns on your money. See, what I want is the drip. I want the $1,600 a month drip, because that's going to go higher and higher and higher as time goes on. Now, this is the daily chart. Let's back this up to a weekly chart on BX, right? And you see these long climb, sweeping crashes, long climb, sweeping crashes. Right? Then let's back this up to a monthly so you can see. And what do you see? Here's the 2008 crash. So it looks like the best thing that could have happened to me is I want you to think about this. So here's the 2008, 2009 crash. I had friends and family who got out of the stock market. They did not want to earn. What they should have done is not worried about getting out of the stock market. They should have worried about is accumulating the stock market. And then as we go forward, what happens? How much money would you have made in this stock? And you think, yeah, well, you're cherry picking stocks. Am I? Well, here's all stocks. Here's the S&P 500. Chart looks very similar to BX, if you notice. Let's go to the weekly, where each bar is a week. And what do we see? Big crash, long sweeping move, big crash, long sweeping move. Let's back that up to a monthly. Each one of these is 1 month. And if we go all the way back to the year 2008, look, big crash. You see what's happening? This stock follows the general stock market. Well, guess what, guys? All quality stocks follow the stock market. And guess what direction all stocks are going? Up. All quality stocks are going up. Not all of them. Some, mess up. They go bad. They do business. They break up. They get something wrong. That happens. But stocks are going up over time. There's plenty of people out there tell you, you can't beat the stock market. Don't try it. Yeah, I get that. Average people can't beat the stock market. I'm not average. I sit around, I read, I study, I apply myself time times amount times yield to this process. Do I always get it right? No. But the way I protect myself is through diversification of different assets. These ones with the higher balance, these are the ones that I've owned the longest. So I've owned Southern Electric, long time, much longer than down here. I don't currently add to this stock anymore. Time times amount times yield. I just let it do its thing. Pepsi, I let it do its thing. BX, I let it do its thing. Chevron, I haven't added to this since the last oil crash. Let it do its thing. McDonald's, it's been years since I added to McDonald's. I let it do its thing. Why? Because as time rolls on, I'm looking to diversify myself into other different types of stocks. So if you come down here, you're going to see new ones that I'm playing with. I've recently started adding PFF, right? And what's the goal? I want to get this to about 10,000, then I'm done with this deal. You know, Hasbro, I've been constantly adding to this stock. It's at 4,500. When it gets near 10,000, I'm done with the deal. So as long as they're under 10,000, I'm looking to add to them on stage ones because I'm playing the game of time times amount times yield. Here I just randomly grabbed another one. Here's Welltower. And you can see, okay, OGP started buying, looks like around 2007. No, it looks like 2016 we had some plays too, but not much. I bought 25 shares, 16, 13, 10, 10, 6, 5, 3, 2, and then I stopped buying, you know. So the last time was in the 2020, I bought just 2 shares. But then look, these are just dividend drips. Dividend drips. So I don't need to do anything with this stock, but just leave it alone. Let time times amount times yield do what it does. And it starts to what? Build the position. And over time, what happens? That dividend, if you notice, look at the dividend. 51, 72, 74, 69, 72, 84, 85, 81. What are you seeing? Slowly over time, that dividend is creeping higher. And so that's the effect of time times amount times yield. So as I go through here and I start looking at these, that's the effect you're seeing is money's coming in on these, and it's up to me as the portfolio manager to allocate where does that money go. So on this account, you can click estimated income and it'll break it down. And then over here, it'll show you the payments. So these are payments that I'm going to receive. So on 8/11, Nucor Steel is going to pay me $35. Hasbro is going to pay me $41. I'm targeting this one. UAN is going to pay me $408. I have this in multiple accounts too. Starbucks, $59. GLV, we've been trying to get this to $100, and then I'm going to stop adding. Hanes Brand's going to be $159. Welltower is $67. Could these change? Yeah, companies can raise and lower the dividend based on the economy, but this is why we diversify ourselves. Pfizer, oh look, Southern Electric. Remember Southern Electric was the highest on the list, $166. I've been using it longer. USA Today, $182. Walmart, Chevron. So this is just money that'll be coming in. This is part of time. When did you get on the train? Remember, stocks are always doing this. This is why people get out. They fear the volatility that could make them rich because they just don't simply understand time times amount times yield. You think you do. People think they understand this. They do not. Most people have a very childlike understanding of these powerful, powerful, life-changing concepts. Man, if I break this down on real estate, it'll blow your mind. When you talk about one house equals $1.1 million. One house in 30 years. Everyone I say that to doesn't believe me. But as I input it and show you on the 4 ways that you make money on real estate, well, stocks doing the same thing, not as aggressive. Real estate's leveraged. Stocks are not leveraged. That's the big difference. That's the big difference in stocks and real estate. Stocks are not leveraged, real estate is, and that's the play. But this is what happens even in stocks or even in real estate, that prices go up, then they come down a little bit. Then they go up, and then they come down a little bit. Then they go up and come down. This is a rigged game. And this is how I became a blue-collar millionaire, is I quickly, once I understood intimately at a higher functioning level of time times amount times yield, I know that every dollar I put in the stock market is going to give me $20 to $30. So $100 will give me $1,000, $2,000, $3,000. Once you understand that, you're gold.